Hey there, fellow investors. Welcome back to the channel. When it comes to investing, history is one of our greatest teachers. Over the years, financial markets have gone through dramatic highs and lows, leaving behind a treasure trove of lessons for those willing to learn. Today, I want to share 5 key economic events from history and how they can offer practical insights to improve your investing strategy right now. Whether you're a seasoned investor or just starting out, these lessons are timeless and actionable. Let's start by looking back at the Great Depression of the 1930s. This was a time of unprecedented financial turmoil, with the stock market losing nearly 90% of its value from its peak. Many investors had placed all their eggs in one basket, relying heavily on equities without diversification. The lesson here is simple yet powerful. Diversify your portfolio. By spreading investments across stocks, bonds, real estate, and other asset classes, you can reduce risk and protect yourself from market downturns. For example, during the Great Depression, bonds performed relatively well compared to stocks. Diversification doesn't eliminate risk entirely, but acts like a safety net when markets tumble. Fast forward to the 1970s, a decade marked by stagflation, high inflation combined with stagnant economic growth. Traditional investments like stocks and bonds struggled to keep up with inflation, leaving many portfolios in the red. However, real assets such as gold, farmland, and commodities thrived during this period. What does this mean for us today? Inflation-resistant investments are crucial in times of rising prices. Consider adding assets like Treasury inflation-protected securities, TIPS, commodities, or even real estate to your portfolio. For instance, farmland values surged in the 1970s as agricultural commodities soared. If inflation concerns are on your radar now, think about how you can hedge against it. Next up is the dot-com bubble of the late 1990s and early 2000s, a vivid reminder of what happens when hype overtakes fundamentals. Investors poured money into internet startups with little regard for profitability or business models. When the bubble burst, many lost fortunes as tech stocks collapsed. The takeaway? Always prioritize fundamentals over hype. Before jumping into an investment that seems too good to be true, ask yourself, does this company have a solid business model? Is it profitable or on a clear path to profitability? In today's world of meme stocks and speculative cryptocurrencies, this lesson is more relevant than ever. The 2008 financial crisis brought another critical lesson: understand and manage risk. This crisis was fueled by excessive leverage and risky financial products that few truly understood. When the housing market collapsed, it triggered a domino effect that nearly brought down the global economy. For individual investors, this underscores the importance of knowing what you're investing in and being mindful of your overall risk exposure. Tools like stress tests for your portfolio or simply maintaining a balance between high-risk and low-risk assets can help you weather financial storms. Finally, let's talk about something more recent: the COVID-19 market crash of 2020. This crash was one of the sharpest in history, but also one of the quickest recoveries. Many investors panicked and sold their holdings at rock-bottom prices, only to watch markets rebound within months. The key lesson here is stay calm during volatility. Market downturns are inevitable, but history shows us that they're often followed by recoveries and sometimes even new highs. If you're investing for the long term, avoid making emotional decisions during market turbulence. Instead, focus on maintaining a diversified portfolio that aligns with your goals and risk tolerance. Each of these historical events teaches us something valuable about navigating today's markets. Diversification protects against uncertainty. Inflation hedges safeguard purchasing power. Focusing on fundamentals prevents costly mistakes. Understanding risk keeps you prepared, and staying calm ensures you don't miss out on recoveries. As we wrap up this discussion, I encourage you to reflect on these lessons and think about how they apply to your own investing journey. Are you diversified enough? Have you considered inflation-resistant assets? Are you chasing hype or sticking to fundamentals? These are questions worth asking as you build or refine your portfolio. If you found this video helpful or learned something new today, don't forget to hit the like button. Share it with friends who might benefit from these insights, and subscribe for more practical investing tips like this one. And hey, Drop a comment below if there's a historical event or lesson you'd like us to cover next time. Don't forget to turn on notifications so you never miss an update. Thanks for watching. Happy investing.